investing out there. There's a ton of different approaches. And I personally like to ask some deeper questions. I try to find a unique angle and a true advantage as an investor. In this video, I'm going to share some thoughts on what I think might be the essence of investing.
What's good, y'all? In this live stream, we're going to be connecting what are some fundamental ways to look at investing and how can we connect that to cryptocurrencies. Let's get into it. Let's react to this video by Dave Lee, and it's called The Essence of Investing. What is it? Is there fundamentals? Are there principles that we should stick to? And how does that connect to cryptocurrencies? Is cryptocurrency a Ponzi scheme? Let's find out. Bye.
All right, so as usual, all my videos are a stream of consciousness, and it's what I'm thinking right now and what I'm processing right now, and it's bound to change over time with more information. If you ask me the same question about what's the essence of investing, let's say a month or a year later, you'll probably get a very different answer. And it's because I think sometimes certain topics and questions, let's say like the essence of investing, are quite profound. And at a certain time and stage and period, one might be looking at part of the answer. It's like looking at a big sculpture. Let's say you have a big sculpture of an elephant, and one day you're looking just at the foot. And another day you might be looking at a different part of the elephant and it looks completely different. And so in today's video, I'm taking kind of a today's look, a current look on what I might be thinking this morning about the essence of what investing is. I think investing at its core is about growing resources. And I personally don't like to use money actually as the starting point, because I think money, or quote unquote,
That's interesting.
money, cash, whatever you call it, it's very loaded, and there's a lot of baggage that surrounds that concept and that narrative of money. And also I think when you start with a view of money, I think it's a bit narrow. I'd rather use a term like resources or assets. Resources can include things like money. It could include, physical things like, let's say, buildings, or even digital things, ownership in different companies, etc. But all of this stuff are things that are tradable, that people ascribe value to. So what I call resources or assets is something that you could easily exchange for value. Now, investing, in my opinion, is about growing those resources. Some people, and a lot of people in the investing culture at large, thinks about investing more as growing money. But I think, however, that misses the point, because money, in a way, I think is more of a way to ascribe value to those resources and assets. But the focus shouldn't be necessarily on money, because I don't think that's inherently valuable per se. The focus should be more on the resources and the assets.
I completely agree. There was a guy called, there's a person, Naval, I think he's a billionaire, and he describes money as the means of which money is trying to be a sense of value, but it's really just an IOU of, hey, you did something in the past, and we owe you something in the future. And we've convinced a bunch of people that money is the answer and money itself is valuable. Money solves all your money problems, but at the end of the day, the essence of investing, which we're kind of going to piece together with cryptocurrencies, isn't about how much the price moves up. And that's kind of what I'm piecing together here from what he's telling us.
So one might ask, how fast should one grow their assets? And I think there are a lot of factors. Most people, and the whole investment culture at large, thinks in terms of percent per year. I think the percent per year construct is actually, in my opinion, it's an incremental kind of thinking construct. And I personally think it has some lack, and I prefer a different type of thinking construct with investments. Personally, I like the idea of doubling, going simply from 1 to 2, or 2 to 4, or 4 to 8. And I think this idea of doubling is a much kind of more fundamental thinking construct that's more helpful to think about investing than a percent per year gain. Doubling is found in nature everywhere. For example, you have reproduction, right? Cells, they reproduce, they double. You have animals, they reproduce. Think about, you have a flock of cows or sheep or whatever, and you can think about your flock or your animals doubling over time. And this concept of doubling is in stark contrast to the idea of preserving. See, when you think about percent per year, it's actually all muddled because, what percent per year is about more about preservation versus what percent per year gain is more about doubling. It's kind of confusing, but when you kind of isolate true investing more as doubling your assets at, let's say, some type of reasonable time period, then you can start to make a contrasting view on what preservation is. Now, I think preservation is an important concept to understand. And I think preservation actually has its place, but I think a lot of times people are confused because they include preservation into the concept of investing. And maybe overall, the whole word investing is the wrong word. Maybe we should throw that whole word out because in a way, maybe investing has been too diluted in its meaning, because investing can mean everything and anything. It can mean preserving, it can mean doubling, it can mean gambling, it can mean whatever. And I think this is part of the problem when you try to get to the essence of investing, is what if the whole word or concept has been so diluted or has so much noise in and of itself?
I think I'm going to try and cover my interpretation of what he's saying. When he talks about the percentage, the whole industry of investing and Wall Street looks at average percentage per year, right? And from my understanding, if you focus on, okay, what's my average percentage of gains in this certain time block, it's kind of reducing. If that's your priority and focus of how much you're averaging, it's almost like you're taking the attention away and the potential from massive upside. Like, for example, Tesla, right? For 5 years, stock did nothing. If you bought that in the beginning, like maybe 2013, it's pretty obvious that you're not really prioritizing what your average percentage year is, since you're considering, hey, I think this is a long-term hold, maybe 10, 20 years from now. And that was back in 2013. You're not looking at the average. And we can see that the results of, if we can look at Tesla price, let's go to Yahoo Finance. I hope that I'm explaining this right and what this has to do with cryptocurrencies. Let's look up Tesla, right? So if I were to be somebody that was strictly focused on average interest per year, right? Throughout this whole time period, from 2013 all the way to 2019, 2020, I would have been considered the worst investor in the world. You know what I mean? Obviously, I can't say that I was invested in Tesla back in 2013. Well, how old was I in 2013, bro? I was like, I don't know. I was like, I can't do math. 2002. I was 11. I wasn't invested in Tesla at the age of 11, okay? But I'm just saying, that is my take on what he's kind of saying about percentages versus doubling. Let's stop interrupting him.
Anyways, I want to separate kind of preserving for a second, and doubling. When you preserve, the focus is more about keeping the capital, right? Not losing. So the focus not necessarily is on the doubling. The focus is on the principle, keeping your one safe. Now you might get a few percent or several percent a year in terms of growth or income or gain. However, that's not necessarily the focus of, let's say, preservation. However, when you contrast that to doubling is more about what can we do to double, right, these assets or these resources in a reasonable amount of time. For example, if I'm trying to double my resources in 10 years, that's going to be about a 7% year over year growth, meaning every year my assets need to double, let's say, or need to grow 7% year over year. Now that's an average. And I talk about this often in my channel, but it's the power of 72. When your cumulative percent gains, right, every year add up to 72% over time, that's a doubling of your money, generally speaking. Now you can adjust your time period. If you want to double every 7 years, that means your annual compound.
I need to repeat that. My fault, y'all. The power of 72. So if on average you're getting 7% every year.
Power of 72. When your cumulative percent gains, right, every year add up to 72% over time, that's a doubling of your money, generally speaking. Now you can adjust your time period. If you want to double, a doubling of your percent gains, right, every year add up to 72% over time.
72% over how much? So okay, let's do the math on here, bro. I'm not good at math. So let's just look up calculator, Google calculator. Okay, let's do some rough estimates here. Calculator. And let's look up average 7% over the course every. Did he say every year? Okay. Well, I don't have to do 7 times 10 because he said over the course of 10 years, if you're looking 10 years in the future. Okay, interesting.
That's a doubling of your money, generally speaking. Now you can adjust your time period. If you want to double every 7 years, that means your annual compound growth rate needs to be about 10% every year. And if you want to put it more in safer investments, it could have a longer time period. Now, what kind of investments, right, can be a doubling? So I want to share some thoughts on real estate because I think real estate also can be very confusing for people. In some ways, real estate can be a preservation play. For example, you're keeping your assets somewhat safe if it's in a good area and you get, let's say, a few percent passive income per year, or you could actually be growing, right, that asset through appreciation. I think one of the keys with real estate is that if you're in a high demand growth area, meaning this area is very attractive and a lot of people are latching on to this area as a potential growth area, then there's actually great opportunity to actually double your real estate with appreciation because more demand will increase the price. Another interesting thing about real estate is that leverage changes the game. If you're putting down, let's say 20% on a house or a property, you can get actually a lot of leverage because you're not having to fork over 100% of the money. But let's say on the other hand, you're buying a $1 million house and you're paying full cash for that $1 million house. If that $1 million house doubles hypothetically to $2 million in value in 10 years, then you're going to be basically doubling your money. Your $1 million becomes $2 million over 10 years, right? That's about 7% year over year growth. But then you're going to have to minus any commissions and any closing costs and any expenses that you had along the way. Now, on the flip side, if you actually took a mortgage, so let's say you put down 20% down and you took an 80% mortgage on this $1 million house, so you're putting down $200,000. And let's say hypothetically the house goes up, increases in value by $1 million in 10 years. Then your $200,000 just became $1.2 million in 10 years. And that's a 5x return. So, I mean, it's a completely different story to 5x your money versus just doubling your money. Of course, in this mortgage example, you're going to have remove stuff or deduct commissions, extra closing costs, extra mortgage costs along the way. And that's something to consider. However, when you're taking out a mortgage, especially let's say in some countries that have great protection, you're limited on the downside because the most you could usually lose is your down payment and you get your credit, right, dinged. But
watch what I'm finna do here, y'all. Watch what I'm finna do here.
It's hard to find that type of limited liability leverage in different type of investment areas because it's leverage where you can 5x, let's say, your exposure, but you're limited in your exposure to the downside. So you have a tremendous upside. The key, though, in my opinion, to real estate is that it's got to be a high growth demand area. I don't say got to, but your chances improve radically if you choose a high growth demand area, something that the prospects for that area are growing tremendously within, let's say, 5 years, if not 10 years. Another thing that makes real estate attractive overall, I think, is you've got an environment of low interest rates overall, and you've got an expanding money supply by the Fed. And all of these things really lend to an environment where over the next 5 or 10 years...
I'm gonna try and find something that this is...
areas.
Okay, let me look at the comments.
Some of the different challenges, I think, that people
definitely go on for hours, Dave.
And the reason why I talk about this is because I think real estate can be great at a certain stage, and at different stages it needs to adapt. For example, there are different challenges and opportunities when you're investing, when you have $10,000 to invest versus $100,000 versus $1 million versus $10 million versus $100 million. You have to approach the investing, I think, somewhat differently, and the opportunities and challenges are different as well. So, I mean, all of that said, I think going back to the idea of preservation versus doubling, the question is, okay, so if I'm trying to double, let's say with investing, what time frame, right, am I trying to double? But also, what is causing that doubling? And I think that's interesting to think about and understand. Like, you're not just throwing, assets or resources at something hoping that, it'll double. I think at the gist of it is demand is going to make that asset double if it, let's say, doubles over a year time period. And the reason is because demand oftentimes dictates the price of an asset, especially if supply is relatively constricted. So what you have is you have increased demand, let's say for a limited amount of, let's say whether it's shares in a company or it's a house in a certain area, etc. And if demand increases significantly, let's say over 5 or 10 years period, then that's going to drive up the price of that asset because there's more people wanting to pay more for that asset. I think another thing about doubling is it involves a tremendous amount of forecasting. Like, it might be easier said than done, right? Like, oh, pick an area that you think is going to go up a lot, and you can double your assets, let's say in 5 or 10 years. However, I think a lot of this requires some skills with forecasting, and forecasting is an extremely difficult skill to have. You tell 100 people to predict what's going to happen in the next 2 or 3 or 5 years, and it's going to be very difficult to find many, if any, people who really have accurate predictions or forecasting abilities.
That's an interesting point that many people would call it speculating on the price of something. He considers it forecasting if we base it on supply and demand. And I kind of want to piece that together with cryptocurrencies and Bitcoin. So let's look up something like CoinMarketCap, right? If we were to look up CoinMarketCap, y'all, go on here. And by the way, if you think cryptocurrencies is a Ponzi scheme, we have $2 trillion in the market. That's an enormous amount of money. That's more than many countries. And that money, there could be a reduction, absolutely. But $2 trillion, a lot of this money isn't going anywhere. So let's look at something like Bitcoin, right? Circulating supply, 18 million Bitcoin. The supply and demand of Bitcoin is pretty much, from my understanding, it is set in stone, so to speak. It's set in digital stone, where every, I believe, 4 years, the supply of Bitcoin, hey, I don't want to butcher this, right? So I'm going to look it up so that I can have a better description of it. But the way that it was set up, Bitcoin supply and demand, the way that it was set up was intended for it to be a deflationary asset. Let's look at Bitcoin having Bitcoin halving explained.
What is having Bitcoin? No, not having Bitcoin. Having Bitcoin. What does it mean? When does it happen? What happens to the value of Bitcoin when it does happen? Well, stick around. Here on Bitcoin Whiteboard Tuesday, we'll answer these questions and more. From 99bitcoins.com, and this is Bitcoin Whiteboard Tuesday. During each edition, we'll go over some basic ideas about Bitcoin. That way, you can learn more about Bitcoin yourself or forward these videos to friends or family or group of people, discord people with new Bitcoin for doing the work of verifying new
See, this is my patience problem, y'all. This is my patience problem.
Who should get them? The idea, called Bitcoin mining, was to reward people with new Bitcoin for doing the work of verifying new transactions into new blocks through computational work. Okay, I lost some of you there. For a better understanding of mining, check out our episode titled, What is Bitcoin Mining?
Okay, so basically, since Bitcoin is a public ledger, right? We have this public ledger of a bunch of transactions happening, and we need to make sure that those transactions are verified, to make sure that, hey, this person didn't spend money that they don't have. Hey, this person didn't double spend. All of that, yada yada yada, and the people that do that get rewarded Bitcoin.
Suffice to say that new Bitcoin is created as a reward for miners verifying blocks in the blockchain.
New Bitcoin is created every time as a reward.
When Bitcoin started, the reward was set to 50 coins per block. But Nakamoto put into the protocol a rule where every 210,000 blocks, or roughly every 4 years, the reward would be cut in half, and so is named a halving event.
That's what I was talking about, the supply and demand of Bitcoin. So that by I think 4 years from now, the halving of Bitcoin, the rewards, what is Bitcoin rewards right now? What is the current mining reward in Bitcoin? Let's look at that in 2020 so far. Currently at 12.5 Bitcoin. It's gonna lower to 6 Bitcoin in 2020, which already happened. Okay, so 4 years from now, or 4 years from 2020, the supply of the rewards that you get for mining Bitcoin is gonna happen, which will it increase the value of Bitcoin, which is at currently $60,000? We already know that the supply of it, which is 18 million, right, is set in digital stone, all right? And so basically the maximum supply we can ever get is 21 million. And that's including everything that we've already lost. You know, keys that people have lost in the past. Basically all you need to know is that the max supply of Bitcoin is 21 million. And if that's true, that's why people are comparing it to digital gold. And what he's talking about was speculating or forecasting. Are you able to accurately forecast the price of Bitcoin based on the knowledge about its supply and demand? Let's see.
Overall, I think with forecasting, the broader and the deeper you go, the better your forecasting can get. And what I mean by this is, I think the world is so complex. Oftentimes we think that investing is actually a financial activity, but in a lot of ways, investing is more than a financial activity. It's a world activity, meaning you have to understand and forecast where the world is heading, not just financial markets, right? You have to understand people's adoption habits, businesses, technology trends, culture, just world events. There's so many factors involved. And it's, in my opinion, there are thousands, if not hundreds of thousands of various factors that are beyond just a typical, let's say, financial, understanding of things that one needs to, I think, be exposed to and have a grip of to really have, I think, outstanding forecasting abilities. Oftentimes,
I'm going to cut him off because that is an extremely important point. When we talk about, we have to understand almost everything that's happening when it comes to investing in order to have a good foresight. If we were to look at cryptocurrencies, the people with the most foresight were the people that were looking at everything that was happening in the cryptocurrency industry. The people that saw, hey, people are starting to move away from Ethereum a little bit because of these problems. Maybe we should take that into consideration when buying Ethereum. The people that saw the people that saw the problems with Bitcoin in 2014, 2012, and moved on to Ethereum, the people that saw that happening were the ones that were excited about Ethereum. I don't really have a strict, like, I'm trying to piece this together. This is just some thoughts, you know what I mean? How can we piece together knowing as much as we possibly can about the world and how that pieces together with cryptocurrencies? So I think that because cryptocurrencies are going to impact the entire world, there's many people who are forecasting, you can call it speculating, that cryptocurrencies are going to be more disruptive than the internet. And so the people who are forecasting that, if they have, if you're assuming something like that, what is that based off of? Behavior type of thing, people's behavior, how they are excited about technology, certain technologies. Many people, FOMO, that's a huge thing. That's influencing the way the crypto space is moving right now. There's many different ways we can look at it, and what he says about improving our forecasting abilities.
Understanding of things that one needs to, I think, be exposed to and have a grip of to really have, I think, outstanding forecasting abilities. Oftentimes, and it's part of our kind of education experience, we're not exposed to enough things broadly and enough things deeply enough. One of the things is I come back to kind of with my kids is kind of encouraging a Renaissance man or person type of education where it's a broad set of topics, and it's not just a shallow exposure to topics like philosophy and history and science and math and writing and all sorts of stuff, and even sports and creating all this stuff, but it's also a deep understanding. And sometimes that seems impossible in our current day type of education mindset where we think we can only learn like one thing good or well. But I think there's an advantage when you go broadly across many different topics and many different ways of thinking, and that allows you to synthesize that to understand the world in a deeper way and where it's headed. A lot of times I think we're trained by culture, by social media and apps to be reactionary, right? To have just a shallow following, a shallow understanding of things, and we think of things and we think that's going to be good enough, and it gives us the ability to talk about whatever, but rather shallowly, and everyone else around us, thinks the same way. But I think that's one of the pitfalls or the traps of modern culture and investing, is tempting people to think that, oh, they could have these great odds of doubling, let's say hypothetically, resources without having the broad and the deep enough understanding of where the world is and where it's headed. I also think here's a completely another type of angle on investing, or let's say doubling. I think doubling also involves a certain level of loose hands. And what I mean by this is that you've got to be able to give away the money and exchange it for something else that you think will have more value in the future. For example, if you're too scared all the time and you're holding on to money, you can't give money away because you're just like so clingy to that money, then you're not going to have the ability to let that money go into something that's going to become more valuable, right, over time.
Absolutely. If you're worried about preserving your money, what he's saying is that, like, let's say in 2015, right, you believed that Bitcoin was a huge potential and something valuable in the future. But if you're worried about, let's say you have a tendency to be more risk averse, it's going to be a little bit harder to put your money in something so volatile. Or maybe it can even be something having to do with an actual company, a project like Cardano. You don't want to look at surface level things, what he's talking about, the concept of barely reaching the surface, barely deep diving things. You want to have a deep understanding of this, and that hopefully will influence the way that you make investment decisions versus you making investment decisions based on wanting to preserve your money. You got to be willing to give, because at the end of the day, you get what you give.
time. And I think that's why sometimes this whole thing of being greedy and being so scared or so fearful, that actually more lends to a preservation approach where you're just trying to keep what you have, right? And you're not trying to double your money. I think this explains somewhat of the reason why when you have, for example, quote unquote generational wealth, you have, let's say one generation, let's say create assets, build those assets. The second generation, the tendency is to be preservation focused because they just don't want to lose all of that money, right? Or all of those resources. So they're fear-based. And out of fear-based, that just isn't the attitude you're going to have that's really going to let you and empower you to become a great doubler of assets, right? And I think that's why with investing, it's so hard to have this more multi-generational, approach or philosophy with investing, because it requires kind of this letting go, right, of money, not being too afraid, right, to lose that or to give it away. And if you're born into a rich family, what are you gonna be afraid of? You're probably gonna be afraid of losing all the money, right? That's just the biggest, thing that's so apparent, right? And the whole concept of doubling it probably doesn't appeal to you as much as trying to, right, not lose that money. I personally think that there's a way to blend these things together where rather than, let's say, haphazardly like throwing this money on the wall, etc., that you can cautiously and carefully and thoughtfully have a letting go of money, meaning you cautiously and thoughtfully research and search out and diligently, find opportunities, but you do so with a cautious attitude, yet with an aggressive kind of letting go attitude, where you're not scared, right? Of
cautious but aggressive, yo. My hope with this channel and with what I'm doing in the future is that I can find opportunities with an attitude of, hey, I'm going to understand everything about this. I'm going to understand everything. Where I can be cautious, tread lightly, but also aggressive, depending on my understanding of what I'm investing in.
Losing those assets. And overall, I think it helps the structure of the type of assets and where your resources are located. If you're able to have resources and assets that are located and kind of split, and this is kind of my personal approach, is one kind of set of assets is set more to preservation, where, it maybe covers your living expenses, there's some passive income, etc. So it alleviates some of that, let's say, fear and anxiety toward the future. And then you have another set of assets that's more geared toward aggressive doubling. And by pairing a lot of these different skills that I'm talking about, let's say cautiously and thoughtfully researching stuff, but yet, not being so scared, and really focusing on broad and deep understanding of the world and where it's headed, understanding the concept of how things double, right? And the role of demand, and kind of your front-running demand, you're front-running people's behaviors in a way. Because you think, hey, in 5 years, 10 years, this is what people are going to want. This is what they're going to buy. This is what they're going to value more than they value right now, right? And in a lot of ways, it's this idea of living in dual worlds, where one world you're looking at right now, understanding the present value of things, where people are at, but you're also understanding the world 5 or 10 years from now, how that world's going to shape out and look like, and how the values are going to be different, and what people are going to be valuing more at that time than they do right now.
Looking at the world in the lenses of a dual world. That's the hope with cryptocurrencies, bro. I'm kind of going to try and piece this together with cryptocurrencies, but at the end of the day, it's just some thoughts. Understanding, okay, this is how people are valuing cryptocurrencies right now. But in the future, if you have an understanding of how that technology, how these projects are going to be extremely valuable and actually used, more impactful than the internet, you're looking at two separate worlds. And that's a strength in many cases, as long as you have a deep understanding of both worlds and the distinction between the two. I hope that explained it. I hope that I'm not looking too crazy. Who is this kid? What is he talking about? That doesn't change my mind about Bitcoin being a Ponzi scheme. But at the end of the day, y'all, if we look at CoinMarketCap, if we just simply look at this right here, $2 trillion, that's amount of money that we can't even understand. $2 trillion. it just sounds like another version of billion, right? But we have, I think, I'm not sure if Elon Musk is the richest man in the world still, but him and Jeff Bezos combined are something like 250 billion in terms of net worth, and that's just a guess, okay? A trillion? I'm gonna look like an idiot trying to do the math, but y'all get my point, okay? A trillion is 2 trillion, that's even more. That's not going anywhere. The excitement, the community that comes with cryptocurrencies, and me personally, I'm invested in Cardano. This creates ecosystems. This creates businesses. If y'all have seen just Cardano and their deal with the Ethiopian government, they signed some type of deal with Ethiopia. This is a technology and projects that are going to be used in the real world, whether you believe it in it or not. And it's something that I'm going to be continuing to look into. What is the distinction between how cryptocurrencies are valued today? And where can I give my money for the future? Thank you all so much for watching. Goodbye.